Here's something that'll blow your mind. Right now, as you're watching this video, there are people living in massive mansions around the world. They're driving million-dollar cars and taking private jets everywhere, and they're paying almost zero in taxes. Not because they're breaking any laws, not because they're hiding money in some shady offshore account, but because they know something about the tax system that most people will never discover. I'm talking about a wealth strategy so powerful that it literally has its own name in academic circles. It's been used by ultra-wealthy for over a century. Chances are you've never even heard of it, but once you understand how it works, you'll never look at wealth and taxes the same way again. This isn't clickbait, this is real, and by the end of this video, you're going to understand exactly how the wealthiest people on the planet legally avoid paying taxes. They avoid paying taxes on billions of dollars. So if you're ready to peek behind the curtain and see how the game is really played, hit subscribe and let's dive in. The strategy I'm about to reveal has a simple name: buy, borrow, die. 3 words that unlock a financial playbook worth trillions. This phrase was coined by Professor Edward McCaffrey at the University of Southern California back in the mid-1990s. But here's what's really interesting about this. Professor McCaffrey wasn't trying to help rich people get richer. He was trying to explain to his law students why the American tax system seemed so fundamentally broken. For years, tax experts dismissed his explanation, saying it was too simple to reflect the complex strategies used by the wealthy. But then something happened in 2021 that changed everything. ProPublica, the investigative journalism organization, obtained thousands of IRS records belonging to the wealthiest Americans. When they analyzed this data, they discovered something shocking. The richest people in America weren't just paying lower tax rates than middle-class workers. Some were paying almost nothing. Warren Buffett, one of the world's richest men, paid just a 0.1% tax rate from 2014 to 2018. Remarkable. Jeff Bezos paid 0.98%, Elon Musk paid 3.27%, while the average American paid 15 to 30% of their income. Suddenly, Professor McCaffrey's 3-word explanation didn't seem so simple. It perfectly described how wealth works in America, and the most frustrating part: everything about this strategy is completely 100% legal. That's right. It's all within the rules of the current tax system, and it's been this way for decades. Let me break down exactly how buy, borrow, die works, because once you understand the mechanics, you'll see why this is such a game changer for the wealthy. Phase 1 is buy, and this is where everything starts to diverge from how most people think about building wealth. Let me explain the fundamental difference here. See, most people earn income through their job. You work, you get paid a salary, and immediately the government takes their cut before you even see the money. Income taxes, payroll taxes, Social Security, Medicare, it all gets deducted before you even see the money. Then you take what's left and try to save it or invest it. But wealthy people flip this equation completely. Instead of focusing on earning income, they focus on acquiring assets that appreciate in value over time without producing regular taxable income. We're talking about stocks that don't pay dividends, real estate that increases in value, art collections, private business ownership, basically anything that grows in value over time, tax-free. Here's why this matters so much in the American tax system. You only pay capital gains taxes when you sell an asset. As long as you hold on to it, no matter how much it increases in value, the IRS can't touch those gains. It's called unrealized appreciation, and it's completely tax-free under current law and regulations. Let me give you a concrete example. Imagine you bought Amazon stock 20 years ago for $100,000. Today, that same investment could be worth $10 million. That's a $9.9 million gain, but as long as you never sell those shares, you owe exactly $0 in taxes on that gain. Absolutely nothing. The government knows your stock is worth $10 million. They just can't tax it until you sell. This is the fundamental loophole that enables the entire strategy to work. This is the fundamental difference between how the wealthy build assets versus how everyone else does. Regular people earn taxable income first, then try to invest what's left over. Wealthy people acquire appreciating assets first and figure out how to access that wealth later without ever triggering a taxable event. That's the key distinction right there. But here's where it gets interesting, because at some point you need actual cash to live on, right? You can't pay for groceries with unrealized stock gains. You can't pay your mortgage with an art collection. So how do wealthy people actually access their wealth without selling their assets and triggering massive tax bills on everything? That brings us to phase 2, which is where this strategy gets really brilliant and where most people have absolutely no idea this mechanism even exists for the wealthy. Phase 2 is borrow, and this is the part that completely changes the game. This is where the wealthy unlock their wealth without paying any taxes whatsoever. Once you have substantial assets, you can use them as collateral to secure loans. And here's the beautiful part. From a tax perspective, borrowed money is not taxable income. Think about what this means. If you have $10 million worth of stock, a bank will happily lend you $7 million against that portfolio, tax-free. That $7 million flows into your bank account completely tax-free. You can use it to buy houses, cars, take vacations, invest in more businesses, whatever you want. And as far as the IRS is concerned, that money doesn't exist. It's not income, it's borrowed funds. So there's absolutely no tax liability on that $7 million. The financial industry has developed sophisticated products specifically for this purpose. They're called securities-based lines of credit, or portfolio loans. Banks love offering these to wealthy clients. Banks love offering these because they're extremely safe from the lender's perspective. Your collateral is sitting right there in your investment account. If you default, they just seize the assets. And the terms are incredibly favorable. If you're wealthy, interest rates are typically lower than traditional bank loans. We're talking about 2 to 4% annually in many cases. The larger your portfolio, the better rates you can negotiate. Some ultra-wealthy individuals can borrow at rates barely above what the federal government pays on treasury bonds. But here's where it gets even more interesting. While you're living off this borrowed money, your assets continue to grow, compounding in value year after year, tax-free. So let's say your stock portfolio is earning 8% annually in market returns, but you're only paying 3% interest on your loan. You're making money on the spread. Your wealth keeps compounding while you access liquidity without any tax consequences. This is how the ultra-wealthy live lavish lifestyles while appearing to have no taxable income at all. This creates a perpetual cycle that can theoretically continue indefinitely. As your assets appreciate, your borrowing capacity increases. You can take out larger loans or refinance existing debt. Meanwhile, you're living a lavish lifestyle entirely on borrowed money, while your actual wealth grows untouched in the background, completely shielded from taxation. It's absolutely incredible when you think about it. Now, I know what you're thinking. What happens when these loans come due? What if the stock market crashes? What about all this accumulated debt over the years? Well, most of these loans don't have traditional repayment schedules. They're structured as revolving lines of credit. As long as you maintain sufficient collateral value, you can keep rolling them over. And if the market does drop, you simply pledge additional assets as collateral to cover the temporary decrease in value. It's a flexible system designed for the wealthy. But more importantly, there's a final phase to this strategy that makes all of this debt completely disappear, and it's the part that really shows how tilted the system is. This final phase is designed to preserve dynastic wealth across generations, and it's the most controversial part of the entire buy, borrow, die strategy. Let me explain how it works. Phase 3 is die. And no, that's not just a morbid play on words. It's the culmination of a wealth preservation strategy that spans multiple generations. When someone using this strategy passes away, their heirs inherit the appreciated assets through something called stepped-up basis, and this is where the tax code gives the wealthy. Under current federal tax law, when you inherit assets, you receive them at their current market value, not at the original purchase price. This is absolutely critical to understand. All those capital gains that accumulated over decades simply vanish for tax purposes. They disappear completely as if they never existed in the first place. It's remarkable when you think about it. Let me walk you through a real example to show you how powerful this is. Let's say someone named Sarah bought stock for $1 million 30 years ago. Over those 3 decades, she never sold a single share. The stock grew to $8 million during this time. Sarah borrowed against her portfolio multiple times to fund her lifestyle. She took out loans totaling $4 million over the years to fund her lifestyle. These loans were completely tax-free because remember, Borrowed money is not considered taxable income. When Sarah passes away, here's what happens. Her heirs inherit the entire $8 million portfolio at its current market value through stepped-up basis rules under federal law. All those decades of appreciation from the original $1 million to the final $8 million simply disappear for tax purposes. It's as if the gain never happened. Now the heirs can immediately sell $4 million worth of inherited stock to pay off the outstanding loans. And here's the kicker. They owe absolutely zero in capital gains taxes. The remaining $4 million becomes their tax-free inheritance to do with as they please. They can continue the cycle or cash out without any tax consequences whatsoever. Let's put this in perspective. Sarah started with $1 million. She provided her family with a $4 million inheritance. She lived off borrowed money for 30 years. She probably spent millions on lifestyle expenses over those decades. And the total tax bill on this entire transaction? Essentially $0, not a single penny paid in taxes. Meanwhile, if you or I tried to build wealth through traditional methods, working a job and saving our after-tax income, we'd be paying taxes at every single step. Income taxes when we earn the money, capital gains taxes when we invest it, estate taxes when we try to pass it on to our children. It's taxation at every level. The compounding effect over multiple generations creates dynastic wealth that becomes almost impossible to erode through taxation. Each generation inherits assets at stepped-up basis, continues the buy-borrow cycle, and passes even more wealth to their children who then repeat the entire process over and over again, building generational wealth that compounds tax-free across decades and centuries. This explains why wealth inequality has exploded over the past several decades, because you can't tax wealth that never gets realized as income. You can't collect capital gains on assets that never get sold, and you can't eliminate the advantage of stepped-up basis that resets everything with each generation. It's a system designed to preserve wealth at the top. Now, the scale at which this operates in the real world is absolutely staggering. Securities-based lending has become a massive industry worth hundreds of billions of dollars. Major financial institutions offer these services as standard products for high-net-worth clients. It's become a routine part of wealth management for the ultra-wealthy across America. The minimum to access these programs varies, but most require at least $1 million in investable assets. Premium services might require $5 million or $10 million. Once you meet these thresholds, banks compete aggressively for your business, offering lower interest rates, better terms, and more flexible repayment options to attract your wealth management business. And here's what really drives home how tilted this system is. The more money you have, the better it works. Someone with $10 million can borrow $7 million, tax-free, and live better than most people ever will. Someone with $100 million can access $70 million in liquidity. The strategy literally scales with wealth perfectly. What makes this so frustrating is how our political discourse completely misses the point. Politicians argue endlessly about raising or lowering tax rates on income and capital gains, but tax rates are irrelevant when you never realize any taxable income in the first place. The entire debate is missing the fundamental mechanism by which wealth actually operates today. You could raise capital gains taxes to 90% tomorrow, and it wouldn't affect someone using buy, borrow, die at all because they never sell their assets in the first place. The entire debate about tax policy is happening on a playing field that the ultra-wealthy left decades ago. They're playing a completely different game with completely different rules. This creates a situation where middle-class families earning $50,000 or $100,000 a year pay higher effective tax rates than billionaires. It's completely backwards when you think about it. Teachers, nurses, engineers, small business owners all get hammered with income taxes, payroll taxes, and property taxes. Meanwhile, the richest people control assets worth more than the GDP of entire countries and pay less than 1% of their wealth in taxes annually. Some years, they pay virtually nothing at all, while working families are paying 15, 20, 30% every single year. Now, I want to be clear about something. This isn't some conspiracy theory. This isn't illegal. Every single piece of this strategy is perfectly legal and has been openly documented. The problem isn't that wealthy people are breaking the rules. The problem is that the rules were written in a way that allows this to happen. The system itself is designed this way. Understanding buy, borrow, die completely changes how you think about wealth, taxes, and financial inequality. It explains why the wealth gap keeps growing despite periodic efforts at tax reform over decades. It shows why earned income is taxed so heavily, while investment income can be avoided almost entirely. It reveals the fundamental structure of how modern wealth actually works in America today. So there you have it. Buy, borrow, die. 3 simple words that unlock the secret to how the ultra-wealthy preserve and grow their fortunes across generations while paying virtually nothing in taxes year after year, decade after decade. This is the fundamental mechanism that enables dynastic wealth to compound without taxation at the highest levels. This isn't about glorifying the strategy or encouraging tax avoidance. This is about understanding how the financial system actually works so you can make informed decisions about your future. Because once you know the rules of the game, you can at least make informed decisions about your own financial future and understand why the system works the way it does. If you found this video eye-opening, make sure to subscribe to the channel. I dive deep into financial strategies, wealth building, and the systems that shape our economy. Drop a comment below and let me know what you think about this strategy. Is it fair? Should it be reformed? I want to hear your perspective on this important topic. Thanks for watching, and I'll see you in the next one, where we'll continue exploring how money really works in the modern economy. Stay curious and keep learning.